Hey everybody, Mike Fairborn here. Welcome back to Generating Income in Your Portfolio. Folks, today I want to take a look at a couple of different areas. I wanted to look, specifically at maybe some of the sectors out there, seeing what some of the dividend payers look like in some of the performing sectors, what might be recently turning up, as well as I wanted to kind of compare some of the fundamental strength of companies historically, looking at their fundamental strength, projected strength, and just comparing that with the PE ratio right now. Are there undervalued situations out there with a basket of companies that might carry those higher dividend yields? We're going to be looking at the PEG ratio specifically through Schwab.com that does look at a 3 to 5 year perspective in terms of estimated earnings. And so we're going to be comparing that, taking a look at it. A lot of great information on Schwab.com. Looking forward to going through it with all of you here. How are you? High Speed. We've got Jay Richardson, Robert Boucher, David Trezil. We've got TM as well as Will. Great to have you guys all on board. In fact, I'm trying today to really, provide you some really good insights in terms of Schwab, enlighten you a little bit as to what's there, maybe make some connections and help you along the way, folks. Any questions, comments, throw them in the chat box so we can address this for you. We've got JB out there helping us in the chat, and appreciate him being here. All right, well, with that, let's hit some disclosure items to get going. The information here is for general information purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. With that, too, wanted to state that paper money software applications for education purposes only. Investing does involve risk, including loss of principal. Past performance of any security strategy does not guarantee future results or success. Couple of additional points as we go through it here. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. An ITM option has a higher risk of being assigned early. Now, I did want to take a look today at some of the maybe some short puts as we go through this discussion on already undervalued companies. It might tie in fairly nicely. That's why I mentioned that point there. Next point, though, did want to state just finally that there are risks associated with investing in dividend-paying stocks, including, but not limited to the risk, that stocks may reduce or stop paying dividends altogether. So with that, let's get going here. Hitting off the top upper channel line right there, as you can see, and kind of holding somewhat flat around that level, which, by the way, if we just forget about that flat top channel line as we're looking at the S&P 500 here, folks, as we take a look at this, notice that anytime you do get above resistance and then you just kind of stall out a little bit, it's telling us something really quite interesting about the performance of the stock itself, which is really kind of the basis of the foundation of a bull flag itself. And that is a stronger move to the upside here and a more mild correction coming down like that. So it's holding the majority of its gains, and it's also holding what was resistance. The corollary to resistance would be, and I'll put it up on the upside up top here, would be support. And so that's all else equal, kind of a strong kind of perspective from the market itself. I did want to move in, though. Let's take a look at the NDX next, and then we'll take a look at some of the sectors. Now, the NDX did break above. I don't know if you guys have been attending that market and sectors class on Wednesdays where we do look at this, but this is where these lines come in. We've drawn these lines in here. This is an ascending triangle. In other words, the triangle is ascending, but you're still getting a tighter and tighter range. We did break above the upper channel line of that triangle, and all else equal, that could be considered as a positive. Now, when you break above that level, and if you might get some consolidation points in here too that could be of interest that traders could look at. And we don't know if we'll see that, put a question mark there, but that is sometimes how these ascending triangles will work. They'll go like this, 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 and then what will happen is when you get the breakout of price, they might consolidate a little bit and then continue with the trend, kind of like the trend that we saw through here. The only difference is that you're getting an accelerating trend over here, right? In fact, you can see that acceleration of the trend within some of these tech companies, and some of these do pay dividends. Oh, but you can see the slope was kind of through here. Now the slope is kind of through here, a little bit higher. And that is strength. That's strength. But let's break it down one additional level. It's always interesting to do this, just kind of some of the insights we get on this when we do it. And by the way, if you guys want this, let me know. So then what I can do is share it with you. But these are the grids right here. Let's just go full screen on the grids. Sometimes I'll detach it too, just to kind of bring it up and give us a little bit more room off the top like that as well. But this is all 11 sectors of the S&P 500 with the S&P 500 SPX right down here in the bottom right-hand corner, which we just got through looking at, right? That's the chart that we had of the S&P 500 index that was kind of like that little possible maybe flag pattern over here. So collectively, we're looking at all the sectors here, but what of all these sectors are we seeing the strength? If you guys just look at this, is there anything that stands out to you? Now, I have put in here, I'll change this to yellow, but I have put in here, like, for example, the names of the sectors so you can see them too. And by the way, this is just the percent change on the day as well. But these are the names of the sectors themselves. Anything there kind of catch your eye. Because whatever I see thrown into the chat, there might be a few of them, we're going to go right, based on your response in the chat, I'm going to go right into the scan tab and just do a very, very quick scan and kind of show you something here as we look at a specific sector. So anything stick out to you? There might be some, I kind of highlighted actually originally too. I know there's a little bit of a delay on the chat on the response here, so I'm going to type this in here for just a second. I'll just make a note here. Right there, consumer staples looks somewhat interesting. I don't know if I think we maybe just barely got above the high. It's kind of flagging a little bit like the market down here. There are a lot of dividend payers actually in the consumer staples area. And by the way, the staples have been flat for a long, well, all else equal. I mean, this is a 6-month grid, but that's kind of a little while. We've been flat, not doing too much. Discretionary, exactly, David. So let's look at discretionary first. We'll hit a couple of the consumers. We'll look at the discretionaries. Clearly, I think one of the strongest right there. Good catch. And then maybe the discretionary. But each of these do pay dividends. Now, one key point to note as we compare these two on the discretionary front, folks, when we say discretionary, what does that mean when we're talking about consumers, right? It's discretionary purchases. These are more of the staples that are just, these will kind of do better in good times and bad. But sometimes, when you're looking at dividends and dividend yields and dividend payments especially, they do tend to, in the discretionaries, vary, and they might very well move up and down with the economy, which is what discretionary does. We've seen some strength in the economy. There has been some strength, obviously. Our reference over here again is the S&P 500 index, but there can be some volatility. So sometimes when you see a dividend here, you also have to be mindful of what is the state of the economy. Whereas it's a little bit different, if we're looking at, let's say, for example, the consumer staples, they tend to be on the sort of steady as she goes, even withstanding recessionary periods and sometimes even looking like growth stocks in recessionary timeframes. These can be some of the stronger stocks out there. They're defensive in nature. They're a little bit slower, right? They've got the lower betas. The beta is a reference to the market. The market has a beta of 1. So beta less than 1 just represents volatility that's less than the general market. You're going to get that over here. So low betas. Lower betas. The discretionaries over here, they're going to just tend to be all else equal higher betas. They're more volatile than the general market. So, and of course the market down here just has that is the beta of 1. So just some considerations to look at. If we did start to see weakness in the market, then the staples, sometimes defensive areas, can be an interesting area to look at. But discretionary, definitely, let's pull it up right now and just see what we've got. So there are some easy ways to do it. In fact, what we'll do, we're just going to tap right into the Market Watch tab. Why not? You get a big perspective here. Got a few different columns to take a look at, but let's add one in here that we don't have. That is the yield. So the yield, got the earnings yield. That's not what we're after. That was a topic of a different class. I'm going to take out this one for now, and we can just keep the yield right description. Fair enough. Okay, so here's our yield coming up. Now, we don't have, this is the NASDAQ 100. What I wanted to do specifically was go in by industry. So now we're doing this. I mentioned the scan tab, but I wanted to show you that when it comes to the yield, it's actually, one of these pre-built columns. And so we can just use the Market Watch tab just in this bigger widescreen format easier for us all to see, even on our own individual computers. But if we come down here now under industry, right here, let's hit that discretionary that David had mentioned right there. And we're just going to select everything. Now, there are going to be components in here. And one of the reasons I did this is I wanted to add in the sub-industry too. So let's kill one of these at least. We'll take out the earnings yield. Don't necessarily need that right now. And it looks like everything is still loading. Oh, you know what? Okay, that's right. That's right. Okay. We're going to have to do the scan tab. That's okay. It's no problem at all. Reason being, it's no issue is because, I mean, there is an issue. We have to, one of the key differences is, that's right, because we need to look at the S&P 500 specifically. So notice over here, we could just choose discretionary, and it's like, oh, shoot, nothing's loading up. Well, there's everything is loading up, but there's just thousands of these things in there, right? I mean, thousands of these companies. So what we're going to do, we're going to go over to the scan tab. We're going to isolate this and say, no, we want to look specifically in the S&P 500 right here. And now we want that to intersect with, and this is where these are so important, intersect with right here, now our industry. Now it's exclusively just stocks within the S&P 500 that matched those charts specifically on our grid. Does that make sense? So let's go ahead and click right there. We'll click on discretionary, and I'll show you this right now, you guys. So here we go. So let's go ahead and scan through this, as you can see, and we'll go through there and take a look at that. Okay. Oh, just something came up here. Sorry about that. Sorry, folks. All right, good. Sorry about that. Okay. So what I need to do is let's do this over here. I'm going to go in now that we've got these, and I'm going to highlight this. I'm going to go to custom. And I'm going to come over here. I'm going to point out a couple of things. I'm going to state over here, we're going to put in, first of all, here's the yield. Right here. And we've got the yield column, but I wanted to put in one of the sectors here. Let's see, yeah, sector specifically, because we're looking at sectors. All right, so here we go. Here we go. So we've got the sector. Did it not go in? Okay, I think we're, oh, where did it end up? 1 second. Okay, let's do it. I double clicked on it. Okay, there we go. That was the issue. Got to pull it up from the top now. By the way, there's a couple more I want to kill. Oh, we have the sector. So it is showing right there now. Okay, so let's click on that. And okay, I think we're all set. I don't need some of these in here. Let's see, just take the volume off. Okay, there we go. So I've got our sector, and now we can kind of isolate specifically, you know, what group, I'm sorry, sector, what am I thinking? It's industry. Yeah, sub-industry specifically. We know the sector because we're looking at the sector itself. So let's kill that sub-industry. There's the sector right there. Okay. And so here we have it. Here is the sub-industry, the symbol description sub-industry. And I'm going to pull this over right here and just take a look at the yield. So here are a couple of these that we can look at now, a list as we go through this. Okay, and so let's go through here and do a couple of points. Now, if we jump over here and look at this level, we want to do this right now and point out that here are some of those that are yielding, and those are the highest yields. And so let's scroll down right there. So you can see what we've got over here. So what's really been moving in this group, maybe even over the past week? Right there. So there could be some that have been moving with discretionaries. We want to combine this, though, with the yield. So a really super quick way to do this and actually verify the yield as well. I'm going to keep clicking it until I get this up at the top. All right, so let's scroll on down now and see what we've got. So these are the, oh, why is it putting the bottom? Okay, there we go. One more. Oh, I see. We got to scroll up. There it is. Okay. So this is really what's been moving in this group. And you have to say this too, is that we've got over here, you can see over here, this, the manufacturers, it's really been kind of led by Tesla, has it not? Can you see that? Right here. Footwear, automobile manufacturer. So the next one would be Deckers coming on down. But this is how we can kind of isolate, I'd say, our group over here. Consumer discretionary, right? Versus consumer staples. So let's just see what we've got in the staples. But I honestly think probably Tesla's leading this higher. Okay, so let's do the exact same thing. Once we have this set up, all we need to do now is just simply go over here into our consumer staples. So fast and easy and able to, we're simply able to do this so quick. So let's go ahead and pull this up right now, and I'll show you right now what we've got. So here it's loading up, and we'll see what else we have here. We can check out a couple of these stocks as well as it's coming. It's taking just a second. All right, one more. There we go. Okay, it's still loading. Okay, let's see. Thus far, though, we've got, what do we have? We got Walmart here. We've got, let's see. Oh, it's still coming up. Okay, give it just a second. But let's make sure. I'll make sure you guys have this if you don't already. It's the colored 1 week percent. So I'm going to share this in the box with you. These scripts aren't guaranteed for timeliness or accuracy, but I wanted to just kind of highlight this, show you that this is here. Yeah, industry and sub. The sub-industry would actually give you a little bit more of a breakdown. It shows the staple area plus a specific area that it's at right now. Say for example, it's you got consumer staples, merchandise, retail. There might be another consumer staples specifically, but a little bit more of a breakdown. You can see the actual name of it when it comes in here as staples. So there you go. By the way, I did share that for you guys, and so it should have been sent out. There you go. So that is in the box. There's your 1 week percent, and still loading. My gosh, I think it's going to go faster. I'm in this demo account, so it takes a little bit for it to load up sometimes, but you get the general idea of what we can do. I think some of these up top have the highest. It's still not loading, but Pepsi is one of these on this list as well. A couple to look at. So just a quick way to get a sense, hey, what's moving out there and what also might be paying a dividend yield. And you can reference that right over here. What do we have with Coca-Cola at 3.06? ADM is quite high as well. So that could be viewed over here too. The other thing too, I was going to just highlight real quick is that I sent this tweet out on X today, just kind of showing you, what is out there. This is just a reference to look at, but you can see over here that we've got these companies. I basically just said, hey, spotting historical yield above 90 over a period of time, and that's what we're looking at here. So you can see the historical yield coming up above 90. So that's like the highest yield we've seen in the last year by far on a lot of these. And in fact, I think this one's at 100%. So this has the highest yield on this AOS that we've seen. And actually, these are actually dividend aristocrats. But as you look over here, one of the things you can do too is just kind of cross-reference a historical yield. So here's another one over here as well that's quite high. This is J&J. So still thinking consumer staples. There's Pepsi. Consumer staples, GD, General Dynamics, not a staples necessarily, but you can see how they've really kind of spiked up. And by the way, many of these companies are at longer term support as well. So that can be interesting to look at too. All right. I'll just, be sure to follow James and I. Here is just I'll just copy that link real quick and throw it in if you want to take a look at this. But it is an approach that you can look at to find some of these companies that have had stronger yields over a period of time. Over the last year, where does the dividend yield stand? It's been moving up pretty well on these. These guys have that long history of paying those dividends. Okay, so having said that, let's go ahead and take that off. But you can come back here, and that was just kind of the next thing I was going to say, is you can come in here and kind of compare these companies where they stand, relatively speaking, relative to their historical yields as well. All right. So there we go. By the way, there is a survey link in the chat. If you get a chance to fill that out, that would be great. We're going to dive now right though into some of the information on Schwab. Specifically, what we can look at as it relates to um, finding companies using the screener here. I was going to show you guys what I think is a really interesting approach in using the screener here on Schwab, because we can look at what may be considered like undervalued, like the value is undervalued, but yet there might be that growth driver out there too. I've created this screen which looks at the annual dividend yield at above 1.5%. Let me just switch a different color. 1.5% here on the annual dividend yield. It's on the S&P 500. You're getting a price range, dividends increasing year over year. That's kind of a nice little feature we can add in. I've got a dividend growth rate in there too that we can reference. It's my way of trying to find, dividend aristocrats. This is way more than meets the dividend aristocrat list, of raising dividends 25 consecutive years. It's not that, but you can see over here, earnings per share growth, and the PEG ratio. Okay, so where I want to draw your attention to, I've got this column here, and this column are just simply just screeners. I just wanted to make sure we can see a reference, or not even screeners, just a reference point. We just want to pull data on these and see, is the company raising dividends and what's their dividend growth rate? So it's a good reference when we're looking at income-based stocks, okay? So moving outside of sectors and now looking at maybe a bottom-up search, we looked at how you can do it through a sector view, seeing what sectors are strong and then looking for dividend yields. Now we're just looking from the bottom up. Stocks, instead of top-down analysis, more bottom-up analysis here. And what we're looking at are those companies that have projected growth. And notice over here, let's clear this off. So this projected growth is 3 to 5 years. Now, why is that interesting for dividend-paying stocks? Well, for companies that have a history of paying dividends, and a lot of these are, at least a dividend yield 1.5 or higher, we could easily narrow this down to, in fact, let me just show you this real quick. If I just click on this, we'll go to 2 or higher, 2 or even 2.5. That's a lot of stocks to look at. And look at this. We go to 2.5, 2.5 now. Okay, it's 115 stocks that we've got now. Okay, as we look at this. Now we're looking at more on the dividend side, about 2.5% yield. But one of the key things is what does that growth look like 3 to 5 years out? ADM. I mean, in terms of what the analysts are projecting. Generally with these kind of sometimes slower growing companies, because they do pay the dividend, and a lot of times when they pay that dividend, they pay it over, they've got cash on the side that they're building up, and they're trying to, they're always accounting for that dividend so they can keep, possibly paying that dividend or increasing that dividend over time. It depends on the company, but some companies are really kind of focused in on keeping that dividend growing. But it can be helpful, as they're looking out for that growth. What are we saying with the company? I mean, what are the estimates in terms of growth rates 3 to 5 years out, which might match an investor's holding, time frame holding a particular stock, 1 year to 3 to 5 years out. Okay, is it a positive number? Is it a negative number? That could be very, very important to kind of consider. If it's negative, well, that might have a lot to do with the future of holding that stock for a long period of time, if in fact the analysts are correct. And that's something we could look into, right? So let's go over here and just look at ADM right now. So I'm going to go back to my regular charts over here. Let's just do this. I'm going to go into ADM. ADM's been down a little bit. There was a big gap over here on ADM. Looking at a weekly chart, that's the perspective of ADM. Now, 3 to 5 years out, and it could be 3 and it could be up to 5. So a little bit more longer term approach in terms of what that column was representing. It could be 3 to 5 years. A lot of times, analysts will make estimates on a 3-year. Some of them make it on a 5. This combines every analyst that's making projections on the earnings between 3 and 5 years, just to be exact. Here's even a longer term chart, but if it keeps losing ground, well, there is a support level really long term, but hey, if it keeps dropping year over year, expected to drop just under 10% for the next 3 to 5 years, maybe it comes all the way down to this level. and that can, be kind of a warning sign for you to look at. Now, it doesn't mean that the analysts are going to be right. Sometimes they're definitely wrong, but sometimes, it's easier for an analyst to look at companies that might be a consumer staple type business and make these longer term projections accurately. Not every time, but I've read that, sometimes they can do that a little bit better. So let's just go ahead and take a look at that. So if that's accurate, maybe that could be a risk factor, right? So one thing we can do is just take out everything in here now that is a negative, because there are some negatives in here. So this is how we could adjust this. We go to the 3 to 5 year. I'm just going to say specific values, and maybe we'll say this. We'll say greater than or equal to at least dividend payers grow slow. But if we said greater than or equal to 3%, that's going to cut out all of our negatives, every one of our negatives. And we had a few negatives in there, and we had some that were growing just really, really slow, expected to grow really slow over the next 3 to 5 years. And so that knocks us down to 78 right there. Okay, so now everything in this column should be a positive number. Okay, and it can get interesting because some of these are double-digit growers. And so what do those look like when you're comparing them with a PEG ratio, right? Now, I specifically chose this 3 to 5 year because that is how Schwab is calculating the PEG ratio. PEG ratio, again, is the PE ratio. We know that. That's a popular ratio. Price to earnings. And that's going to be based upon an estimated growth. That's the estimated growth. And the growth rate that Schwab uses is the 3 to 5 years. So if I had a PE column in here, and we just took the PE and we divided it by this column here, it would give us exactly the PEG ratio. What this is telling us is that if your growth rate, which is the denominator down below, is higher than your PE ratio, what people are already paying, price to earnings right now, what are they paying for the earnings of the company right now? And if this is lower, then there is an undervalued situation that could reside here in terms of the PEG ratio, because this is, in fact, that last column, the PEG ratio, price to earnings growth. Okay, and a lower PE and a higher estimated growth rate, that's going to raise that ratio up. It's going to drop it down. I'm sorry about that. It's going to drop it down, but make it more interesting to us, perhaps. The lower, the better. Right? And that could put it potentially, that's where you can get those PEG ratios less than 1. I just want to show you how Schwab calculates it. So the PEG less than 1 is where the growth rate, the anticipated growth rate, is exceeding the PE ratio, or what shares are being priced at in the current market. Earnings, price to earnings. Okay. So that can be really quite helpful longer term. And the higher the number, just the more expensive it is. Now, sometimes a dividend aristocrat like AbbVie is going to have a higher number over here. It's just going to have a higher PEG ratio. And because it's got that history of paying dividends, and they think it's a really stable company, a strong company perhaps. So it's worth more. I mean, people are paying more for it. The price could just be holding higher values based on that. Okay, so that's also a consideration. I wanted to kind of look outside of that. Now that we've got everything positive in this column over here, what PEG ratios are kind of the lowest? We just need to click on it one time and you can really see what we're looking at here. Look at some of these numbers. Merck is expected to grow at that rate. Now that's a really, really high rate, and I don't know what's going on there, but that seems incredibly high. Now you'd want to take a look into this and see, what does the company's drugs, their pipeline of drugs look like? Are their pipeline of drugs, are they really that strong? Are they expecting something significant, the analysts are? That could be a consideration. Now, more than anything, I mean, I think, some of these bigger ones you have to be very careful with and find out what's going on there. There's another one here. But what about here? Like, in the double digits or the lower double digits, what we're getting right over here too. These are all relatively pretty good PEG ratios, as you can see. I mean, on the scale from what we're looking at here, we start to get above 1 at this level. But truly undervalued based upon the way that some investors will look at it when the PEG ratio is less than 1 or close to 1, right? And these are some of the companies that are popping up over here. So energy, financial, you're getting another financial right there. And this is kind of a financial MetLife. You guys get the point? What's going on? So energy, financial, this is kind of like real estate. And then again, so Merck up top, that's the question mark. You have to take a look at that one. I do want to look at the stock though. And Eastman Chemical. So looking at these, maybe just a couple that stand out that are not financially related or energy related. A quick note on energy. Energy tends to be very, very cyclical. So, I mean, it moves up and down with the price of oil, for example. So that's kind of a risk factor there. Okay, could be. With financial companies, yeah, I mean, they can vary for different reasons. But looking outside of that group, I mean, we could see over here that we don't have, I think CE is what? Is it CE? Let me see. I think we can add this in too as a column. Let me just do this real quick. Look at this. Exchange? No. Universe. We have this, which is, sub-industry, same as, but I think, oh, there's the industry right next to it. Sorry. Let me kill that one. We'll go right there. Sectors and industries, yeah. And so we can come over here and just look. We can just select all and see if it gives us a column there. I don't remember selecting this. Yeah, there we go. Cool. It did put, it's the one we just recently added on, so it throws it over here to the right. But these two are actually chemical companies. So we're seeing maybe some of the chemical companies, 1, 2, 3, that are possibly undervalued. As you can see over here, it does give a sub-industry on that. Very, very helpful to see that over the far right. If I move over there. So you've got fertilizers, especially chemicals, and another one right here as well. So I didn't know that about FMC. Let's take a look at the chemical group and just see what they've got and see if there, by chance, is an undervalued situation there, just looking at the chart as well. So let's see, FMC was the first one I wanted to take a look at. Take those off the chart here real quick and see what we've got. Okay, so price is coming down, but you can see we've been in a long sideways channel over here for quite some time. Here is a weekly chart. So basically all this year we've been down, but prices have been dipping. Now, the point of this whole discussion is, if you are looking to try to find an undervalued kind of a situation, it's down. It doesn't look that great. It's been holding this 50 level, which can be a big number down here. But will it continue to hold that level? What is the expectation that we have on the stock itself? Well, let's look at it and look at those specific columns. Well, it's saying right here, the expectation of it is to grow. And by the way, it's being considered undervalued based on a PEG ratio basis. But over here, it's close to 15, approximately just under 15% a year. Those earnings are expected to grow, anticipated to grow. The dividend yield is actually really quite high over here. Has the company been raising the dividend over a period of time, or how has that dividend been doing? For the last 1 year, I'm seeing, let's see, 5 payments there. I'm going to go back to a 2-year here, and I'm just going to see, no, it's been 58 cents across the board. So at least the last 2 years, we could go back and look longer too and see what's going on there. Now, if things are correct, if the price of the stock, and by the way, the last earnings, I think, was right there. The estimates were 49 cents. They came in at 69 cents. So they beat by about 20 cents. It looks like the stock, I don't know what the stock did. It went flat through there and then dipped. I think the whole industry might be in a secular decline right now. But the question is what happens? Here's 50. We've been holding it for a while now. 50. If prices go below here and the earnings of the company stay firm, the value could improve. It's possible for it to improve. So I wanted to look at that and also come over here and say, well, there's 50. I'm going to actually go on a weekly chart to just kind of show you this. I'm going to pull this up, the scale, so we can kind of see what do the options look like. Let's just say going out a month or so over here on the option side. Well, the 50's right here. And how is the liquidity? Well, what are we talking about here? About 15 cents? I mean, it's not too bad. You've got shares over here on this company that are about 1.6 million. We've got open interest in the hundreds. but it's about a 15 cent spread. It might have widened too after the market closed, and that can happen on these. Yeah. So looking at the 47.50, like just consider this. If somebody said, well, it might go sideways for a while, why do I necessarily want to buy into the stock? The 47.50 puts us down about here. Let's say if we were looking, at that strike price, I'm just going to try to eyeball it somewhere in here below the 50 where we've been holding. So we'll just say 47.50. And remember, this is after you've looked at the company, you're fine with those earnings expectations. You think that it could be an interesting place to maybe add purchase shares if you're okay, but maybe get a premium, a put premium to start you on the position, as an example, in terms of maybe an undervalued situation, right? We haven't seen any movement here, so this is totally opposite, but I did want to hit this as a PEG ratio discussion today to a degree, combining, growth with value, expected growth, that is. Okay, so if we have that, and again, what does that do? If the price of the stock holds above that 47.50, which it has basically, you want to say for about a year, it's held above there, above 50. So if somebody had been selling puts around that 47.50 level through the year, if we were just looking at it, just generally speaking, they may have been able to collect premium month to month to month. And these are actually quarters that I'm drawing in here. So there could be several months in there that they could be collecting. Now, it's going to vary. It wouldn't necessarily be 47.50 because if the price of the stock goes higher, of course, 47.50 is going to be worth a lot less in terms of a put down there. But it did kind of hold that level, and there may have been some times where traders could have sold puts around 50 or 47.50, roughly around that support level. Now, they could have collected premium. I know it's all in hindsight here, but generally they might have collected that, if the price of the stock is holding above the strike price by expiration, each expiration month. Okay. If it dips below there and earnings stay strong, well, that could be a time where, you'd still get to collect the premium of the purchase, and then you could look to create a position if in fact you wanted to, because the expectation was, again, let's pull it up. The expectation was expected growth. You've got to be fine with that growth, though. You got to say, I really believe it's going to grow through here. I think the analysts are right over this time frame, because that is a remarkable peg as it stands right now, given that, right? Clearly below 1. CE, I bet CE is going to look somewhat close to this. Wow. CE, that's a big decline. Now, I don't know what's going on exactly there, but it looks like there was a major gap over here. And there's still, even after that gap, yeah, they missed earnings too, unlike the other company that beat. But there are expectations. What does a long term look like? Oh, it's all the way back down to these levels. Sometimes you'll get these sell-offs. And this is where, investors would like to pick this up because the yields are going to be maybe higher. Will it do the same thing it had previously? That's the big question. So people can wait for a bottom in there. I know that's a lot to ask for, but dividend holders tend to, they tend to hold stock a little bit longer, generally speaking. The other one too I wanted to look at too, just while we're at it, was EMN, because it was down. It's got the highest PEG ratio. It's got the second highest expected growth rate. The Celanese was a little bit lower. I'm definitely familiar with this one, this company here, EMN, Eastman. Let's pull this one up. Okay, so this was a little bit different. This is a daily chart, and the stock has been making, this was a higher high, more recently coming down, but this company clearly holding up better than the prior ones. Let's click over here and just take a look, and you can see kind of on the weekly chart, we're coming back down to, well, kind of this support level that has held for a while. Now, will it hold that? It's the big question. Will those growth rates come in? Possibly so. You can watch it around this level. With this kind of velocity coming down too, the short puts, the puts in general might be, they could be priced, obviously, they could be priced higher with, with prices dropping for sure. But we'll see. Let's take a look and see what they're showing us here as well. In fact, if I just draw a line through here, yeah. So that's where that prior support had been. Another quick note on the the puts, if we're selling puts here at or below this support level, for example, if we do cross below that strike price by expiration, if prices come down here and then they, by expiration, they stay below that level, then it's very likely that, just for every one put contract that we sell, will be assigned 100 shares of stock. Now, we still get to collect the option premium. Let's see what that option premium looks like right now. We're at 95. We could say that support maybe, 95, 94 range. What are we seeing below that level that a trader might look to, potentially start a position? Okay. So again, take a look at a few different things over here that we've got in terms of volume on the shares. We're at 1.4 million. We got over here. This is here's our 95. We don't have a ton of volume or open interest on these, and that's really quite wide. Now, I think these did widen a little bit if the market closed. The 90 here is still at, about 20 cents spread, a 20 cent spread. So not a ton of liquidity here. But I'm going to pull this back and just show you how far the 90 is down below here. So if you thought that the price of the stock might hold this level at 95 right here or 90, there is the possibility if prices hold above here, which is what traders would be anticipating, right? If we can hold above that level by expiration, in other words, prices could go up, they could go sideways or down. That is 3 different directions. We could still collect the premium. And if they do go below that 90 by expiration, we'd be looking very likely to, purchase 100 shares of stock at 90. But this premium could offset that price down, the purchase price itself, right? It could lower our total cost, I should say, in that sense. So let's go ahead and look at this right now. I believe this was trading, the spread is a little bit tighter here. It's a little bit difficult in this class because the market's closed and sometimes these will close. But I'm going to do this. I'm going to go ahead on that 90 right there, that 90 strike. And, the 90 strike on the bid, right? That's how we would sell the put. And I'm going to just sell one, but I'm going to bump this up to 80. Okay, I realize, that's quite high compared to what we're looking at. That's the mid right now. But I'm going to go ahead and just hit confirm. Let's just take a look at this right now. So notice what that does with 80 cents, not a ton, right? But it does lower our cost base, our break-even prices down. The max profit would be 80. And if prices are dropping and we do get assigned at that level, we'd be buying shares at a cheaper price, right? And if we're okay with that as earning his expectations, that could be interesting. And then lastly on that, what about our dividend yield? I just went ahead and threw that in our paper trade account. But the dividend yield could climb higher as well because we're getting assigned 90 and we're around 95 right now. So if there's an assignment and we sold the 90, but if the price of the stock goes below that 90 by expiration, well, the dividend yield could also move up higher too. Oops, let me do that again. Right there. So it's at 3.48. All else equal, as long as that dividend payment remains intact, that could be a positive. I don't know how long EMN has been raising the dividend. I can see that they raised it right here. In fact, the dividend X date was actually part of probably that adjusts. I don't know. Yeah. We're not sure on that, but sometimes the stock price will adjust lower based on that dividend payment. I mean, it frequently does. Generally, that is the case. So if you come over here, you can take a look going back. I guess it was about 79 cents a couple years ago, and here we are over there. All right, folks. Well, I did have a topic request on the peg, and so we did hit it. We got the peg under our belt. And hopefully that was useful. There's a lot of great tools right off of Schwab.com. Encourage you to tap into those, especially looking for the growth rates that fit Schwab's calculation of the peg. Folks, if you haven't already, smash that subscribe button at bottom right hand corner of the screen if you like this kind of content. Also, hit the like button if you liked it. There is a survey link in the chat. It was good being with you. Thanks, James, so much for your help in the chat. And folks, all right, take care, everybody. We'll see you.